I think active management in the small and mid-cap space is even more important than the large cap part of the market. If you think about it very simplistically, large cap stocks to some extent have already succeeded greatly. If you have a market cap of 50, 100 billion, or some of these companies are now in the trillions, clearly you have some sort of a proven business model, proven business case, and a reason to be. As you move down the cap range in mid caps and certainly in small caps, that's not necessarily a given. So I think first off, it's important that somebody truly vets those business models, see if they're durable, see if they're well-managed businesses, and I think that's obviously active management more so than a passive exposure to it. There's also a lot of companies in the small and mid-cap space that are unable to fund themselves. They're very early in their development, and they are dependent on public financing or other financing in order to keep their businesses growing. That's great when capital is abundant and you can find a lot of willing buyers to buy those companies. When things get a little more challenging or if the economy slows down, we think it's critical that companies can fund their own growth. We think it's critical that companies have solid balance sheets so that if things get even rockier, they're in good shape. So again, you're only going to be able to ferret that out if you're using an active manager. All of the passive indices are going to own big chunks of these companies that don't fall into that sort of durable category. So I think using active management in the small and mid-cap space, because the risk is higher, because there's more need to sort of really understand the business models, again, it's more important than it is even at the large cap end of the market.